Before you file your 2026 taxes, pull out 3 papers. Your 1099-R, your Social Security tax statement, and your Medicare premium notice, because one changed number can affect more than your refund. It can affect how much of your retirement income gets taxed. It can affect whether an IRA withdrawal pushes you higher than you expected. And in some cases, it can show up later as a Medicare surcharge you were not ready for. This is where many retirees get caught. Not because they hid anything, not because they tried to cheat the IRS, but because they filed the same way they filed last year. Same folder, same software, same tax preparer, same assumptions. But the numbers around retirement have moved. For tax year 2026, the IRS increased the standard deduction to $32,200 for married couples filing jointly, $16,100 for single filers and married people filing separately, and $24,150 for heads of household. The IRS also confirmed a senior enhanced deduction for people age 65 and older. It can be worth up to $6,000 per eligible person, or $12,000 for a married couple if both spouses qualify, but it starts phasing out when modified adjusted gross income goes above $75,000 for individuals, or $150,000 for joint filers, and Medicare has its own number retirees need to watch. For 2026, the standard Part B premium is $202.90 per month. But higher income retirees may pay more depending on income. So before you file, before you assume nothing changed, and before you let one form decide the whole return, here are the 5 IRS updates that change the math on those 3 papers. Because update number 4 is the one many retirees will not see on an IRS notice. They may see it later on a Medicare bill. Retirement taxes do not usually come from one paycheck. They come from pieces. One piece from Social Security, one piece from an IRA, one piece from an old 401k. One piece from a pension, one piece from bank interest, maybe another piece from dividends, a CD, a home sale, or a part-time job, and the IRS does not look at those pieces separately. It puts them on the same return. That is why a retiree can make a decision that looks small in real life and still change the math on paper. A $3,000 IRA withdrawal, a bank CD that finally paid decent interest, a Roth conversion done to lower future taxes, but one that raised this year's income instead. A stock sale to help a child, a pension check that never changed, but now sits next to a larger Social Security statement. None of these looks dangerous by itself, but together they can change taxable income. They can change whether part of Social Security becomes taxable. They can change whether a senior deduction phases down. And they can change whether Medicare sees you as a higher income retiree later. Here's the part many retirees miss. The IRS says your Social Security benefits may be taxable if the total of 1/2 of your Social Security benefits, plus all your other income, including tax-exempt interest, is above the base amount for your filing status. The IRS lists those base amounts as $25,000 for single filers and $32,000 for married couples filing jointly. So your Social Security statement is not living alone. It is sitting next to your IRA withdrawals, your pension, your interest, your dividends, your capital gains. Even tax-exempt interest can count in that Social Security test. That surprises people, because tax-exempt sounds like it should disappear from the calculation. But for Social Security taxation, it can still matter. And if you're already at RMD age, another piece enters the picture. The IRS says required minimum distributions are the minimum amounts you must withdraw from certain retirement accounts each year. And you generally must start taking withdrawals when you reach age 73. So the real problem is not just 5 IRS updates. The real problem is that retirees often have 5 or 6 different income streams touching those updates at the same time. That is why filing the same way as last year can be risky. Last year's return may look familiar, but this year's numbers may not behave the same way. And the first number most retirees need to check is the one many people assume is automatic, the standard deduction. The first update is the number many retirees never look at closely, the standard deduction. We mentioned these numbers briefly at the start, but they deserve a closer look. Because for many retirees, this one line decides how much income is protected before the IRS starts calculating tax. For tax year 2026, the IRS increased the standard deduction to $32,200 for married couples filing jointly. For single filers and married people filing separately, it is $16,100. For heads of household, it is $24,150. That number matters because many retirees no longer itemize. The mortgage may be paid off, work expenses may be gone, the kids may be grown, and the tax return may look simpler than it used to be. So instead of adding up itemized deductions, many retirees take the standard deduction. Think of it like this. Your income comes in first. Social Security, pension, IRA withdrawals, bank interest, dividends. Then the standard deduction reduces the amount that becomes taxable. Gross income, minus the standard deduction, then taxable income. That is why this deduction is not just a boring tax line. It is one of the first filters your retirement income passes through. But here is the mistake. Some retirees assume that because they took the standard deduction last year, there's nothing to check this year. That is not always true. If your pension stayed the same, but your IRA withdrawal changed, the deduction matters. If your Social Security statement changed, the deduction matters. If your bank interest went up because CDs and savings accounts finally paid more, the deduction matters. If you sold stock, took money from a 401k, or helped a family member with one large withdrawal, the one decision can change the return. Because the IRS does not tax your life story. It taxes the numbers that land on the return, and the standard deduction is one of the first numbers that shapes that return. Now look at the difference between a married couple and a single retiree. A married couple filing jointly gets a much larger standard deduction than a single filer. That can become important after filing status changes, after one spouse is no longer on the return, or when one person is handling the same household bills with a smaller deduction. This is why retirees should not only ask, what did I owe last year? They should ask, what filing status am I using this year? And what deduction does that status actually give me? There is also an existing age-based additional standard deduction for people who are 65 or older, and it stacks on top of the base standard deduction. For 2026, that amount is generally $2,050 if you file as single or head of household, and $1,650 per qualifying spouse if you are married. That age-based amount is separate from the newer enhanced senior deduction. And that separation matters, because one deduction may be automatic on the standard deduction line, but the new senior deduction has its own eligibility rules, its own income phase out, and its own trap. That is where update number 2 becomes much more important. Now this is where many retirees may confuse two different deductions. The age-based additional standard deduction is one thing, the new enhanced senior deduction is another. They are not the same, and that difference matters. The IRS says that for tax years 2025 through 2028, eligible individuals aged 65 and older may claim an additional $6,000 deduction. If a married couple files jointly and both spouses qualify, that can be $12,000. But do not hear that, as every senior automatically gets the full amount. That is where the trap begins. To qualify, you generally must be 65 by the end of the tax year, and age is only the first test. The IRS says this enhanced senior deduction phases out when modified, adjusted gross income goes above $75,000 for individuals, or $150,000 for joint filers. So the question is not only, am I 65 or older? The better question is, what does my modified adjusted gross income look like after all my retirement income is counted? That means your IRA withdrawal matters, your pension matters, your bank interest matters, your capital gains matter. Your taxable Social Security may matter, and a Roth conversion done for a smart long-term reason can still raise this year's income enough to affect what you qualify for. That is why this deduction can be powerful, but also easy to misunderstand. A married couple may hear $12,000 and assume it is guaranteed. A single retiree may hear $6,000 and assume it will appear automatically. But the IRS guidance uses eligibility language. Age matters, filing status matters, income matters. And for married taxpayers, the IRS says the married couple must file a joint return to claim the deduction for both eligible spouses. Eligible taxpayers also need a valid Social Security number. So this is not a deduction to guess on, it is a deduction to verify. Here is the simple way to think about it. If you take the standard deduction, first check the base standard deduction, then check the existing age-based additional standard deduction, then check whether you also qualify for the new enhanced senior deduction. And, unlike the older age-based add-on, the new enhanced senior deduction can also be available to eligible taxpayers who itemize. These are separate rules, not one blended number, and this is why retirees should be careful before making large year-end moves. Taking a larger IRA withdrawal might help cash flow, selling investments might help family, doing a Roth conversion might reduce future taxes, but each move can raise current income, and if current income rises enough, it can reduce a deduction that was supposed to help you. That is the quiet part most retirees miss. A deduction can exist and still shrink because of one income decision. So before you file, do not only ask your preparer, did I get the senior deduction? Ask, did my income reduce it? Because the next update is where that same income can push against another wall, the 2026 tax brackets. Update number 3 is where many retirees make a mistake without realizing it. They hear tax brackets, and they think it only applies to people still working. But tax brackets do not care whether your income came from a paycheck or a retirement account. For 2026, the IRS says the federal income tax rates remain 10%, 12%, 22%, 24%, 32%, 35%, and 37%. The income thresholds are adjusted for inflation. The top 37% rate applies to taxable income over $640,600 for single filers, and over $768,700 for married couples filing jointly. That last number may not apply to most retirees watching this, but the concept absolutely does. Because your bracket is based on taxable income, not just Social Security, not just your pension, not just one IRA withdrawal. The IRS looks at the taxable pieces after deductions and other rules are applied. So when a retiree says, "I only took a little extra for my IRA this year," the tax return may see something different. It may see the pension, then the IRA withdrawal, then bank interest, then dividends, then capital gains, then the taxable part of Social Security. And suddenly that little extra withdrawal is not sitting alone. Imagine a retiree needs $15,000 for a roof repair. The money is available in the IRA, so they take it. In real life, that may feel like using your own savings, but on the tax return, a traditional IRA withdrawal can become taxable income. And that extra income can push against more than one wall. It can increase taxable income. It can affect how much of Social Security becomes taxable. It can reduce income-based deductions. And in some cases, it can create a higher income number that matters later for Medicare premiums. This is why I stayed in the same bracket is not the only question. A better question is, what did this withdrawal do to the rest of my return? Because retirement taxes are connected. A withdrawal can touch the bracket. The bracket can touch the tax bill. The income number can touch Social Security taxation, and the same income number can later touch Medicare. That does not mean retirees should avoid withdrawals. Sometimes the withdrawal is necessary. A roof leaks, a car breaks, a family member needs help, medical bills show up. But the timing matters, the source matters, and the amount matters. Before you pull a large amount from an IRA or old 401k, ask what that withdrawal does to your taxable income for the year. Ask whether taking part of it this year and part of it next year changes the result. Ask whether using taxable savings first changes the result. Ask whether a Roth conversion, capital gain, or CD interest has already filled up more of the bracket than you realized. Because for retirees, the danger is not always one big mistake. Sometimes it is 5 normal decisions landing on the same tax return. And update number 4 is where the IRS may not wait for you to decide. It may require a withdrawal whether you wanted one or not. Update number 4 is where the IRS may not wait for you to choose a withdrawal. It may require one. This is the required minimum distribution. Most retirees know the letters, RMD, but many do not know where the mistake actually happens. The mistake is not always forgetting retirement money exists. Sometimes the mistake is assuming one RMD withdrawal solves the whole problem. But the rules depend on the account type. The IRS says required minimum distributions are the minimum amounts that retirement account owners generally must withdraw each year, starting with the year they reach age 73. For traditional IRAs, SIP IRAs, and simple IRAs, the owner generally must begin taking RMDs at age 73, even if they are still working. For workplace plans like a 401k, profit-sharing plan, 403b, or other defined contribution plan, the timing can depend on whether you are still working and whether the plan allows delay until retirement. That means you cannot treat every retirement account the same. With multiple IRAs, you may be allowed to calculate each IRA's RMD separately, then take the total from one or more of those IRAs. But that does not work for every account type. A 401k RMD generally has to be satisfied from that 401k. A workplace plan is not automatically covered just because you took money from an IRA. An old 401k is not always handled like a current employer plan. And an inherited IRA can have its own rules depending on who inherited it when the original owner died, and whether the original owner had already reached RMD age. This is where retirees get blindsided. They look at the IRA they use every year, but forget the old 401k from a job they left 15 years ago. They assume the custodian will warn them. And sometimes an IRA custodian may report or offer to calculate the RMD for the account it holds. But that custodian may not know about your old 401k, another IRA, or an inherited account somewhere else. That is why the first step is not taking a withdrawal. The first step is making a list. Every IRA, every SEPA, or simple IRA, every old 401k, every current employer plan, every inherited retirement account. Then ask 3 questions for each one. Does this account require an RMD this year? Who calculates it? And what is the deadline? The IRS says the required beginning date for the first RMD from IRAs is generally April 1st of the year after the year you reach age 73. But that first year delay can create its own problem. Because if you delay the first RMD into the next year, you may also have to take the next year's RMD by December 31st of that same year. That can put 2 required withdrawals into one tax year. And 2 withdrawals can change the return. They can raise taxable income, they can affect Social Security taxation, they can reduce income-based deductions, and they can matter later for Medicare premium calculations. This is why waiting until December can be dangerous. A missed RMD can trigger an excise tax. Under current IRS rules, the penalty is generally 25% of the amount not taken, and it may be reduced to 10% if the mistake is corrected within the required correction window. So do not wait for the last month of the year to discover an old account. Do not assume one IRA statement tells the whole story. And do not assume an inherited account follows the same rule as your own account. Before filing and before year end, ask your tax professional or financial custodian to help verify every retirement account, because the RMD problem is not always the amount. Sometimes it is the account you forgot to include. And the next update is where even a correct withdrawal can create a surprise outside the IRS return: your Medicare premium. Update number 5 is the one many retirees do not see as an IRS problem at first. They see it as a Medicare bill. For 2026, the standard Medicare Part B premium is $202.90 per month, but that is only the standard amount. Medicare says some people pay more for Part B depending on income. That extra charge is called IRMAA, Income-Related Monthly Adjustment Amount. Most retirees do not need the full name. They just need to understand what it does. It can raise your Medicare Part B premium, and for people with Medicare drug coverage, income can also affect Part D charges. Here is the part that catches people. Medicare is not always looking at this year's income. For 2026 Medicare premiums, the income test is generally based on income from your 2024 tax return. That means a financial decision can follow you, not immediately, later. A Roth conversion, a large IRA withdrawal, a capital gain, extra interest income, a home sale with taxable gain. Each one may look like a normal retirement decision. But on the tax return, it can raise modified adjusted gross income. And for Medicare, modified adjusted gross income generally means your adjusted gross income plus tax-exempt interest. That is the number Social Security usually looks back to from 2 years earlier. For 2026, higher income Medicare beneficiaries may pay more if their 2024 modified adjusted gross income was above $109,000 for individual filers, or above $218,000 for married couples filing jointly. That does not mean every retiree is near those numbers, but it does mean retirees should know where the line is before they make a large income move. Because IRMAA does not feel like a normal tax. It can feel like a surprise deduction from your Social Security check, or a higher Medicare bill that shows up after the tax year is already behind you. That is why this update belongs in an IRS video. Because Medicare may be reading income numbers that started on an IRS tax return. A retiree can file everything correctly, no mistake, no missing form, no penalty, and still pay more later because 1 year of income was higher than usual. This is especially important for Roth conversions. A Roth conversion can be a smart strategy. It can lower future required withdrawals. It can reduce future taxable income. It can help with estate planning. But it also raises income in the year you do it. So before converting a large amount, the question is not only, how much tax will I pay this year? The second question is, could this income affect my Medicare premiums later? The same is true for IRA withdrawals. If you take money from a traditional IRA to repair a roof, help a child, buy a car, or cover medical costs, that withdrawal may be necessary. But it should not be invisible. It joins the rest of your income. And if it pushes you over a Medicare income threshold, the effect can show up later. There is one more detail worth knowing. If your income later dropped because of a qualifying life-changing event, you may be able to ask Social Security to review the IRMAA decision. That does not erase the need to plan, but it does mean retirees should not ignore the notice if their situation changed. This does not mean retirees should avoid every large move. Sometimes the move is the right one. Sometimes the conversion is still worth it. Sometimes the withdrawal cannot wait. But it should be planned with the full picture visible. Taxes first, deductions second, Social Security taxation third, RMDs fourth, Medicare premiums fifth, because retirement math does not stay in one box. The IRS return can affect Medicare. Medicare can affect monthly cash flow. And monthly cash flow is what retirees feel most. So before you file, And before you make a large withdrawal or conversion, ask one specific question. What will this income do 2 years from now? Because update number 5 is not just about what you owe the IRS, it is about what your Medicare notice may say later. Now that you know the 5 updates, there is one more place retirees get caught. Not in the rule itself, in the paperwork. Because the IRS does not only look at what you type into a tax return, it also receives forms from banks, brokers, retirement plans, and government agencies. That is why filing early can feel productive, but still create a problem. A retiree may have the Social Security statement. They may have one IRA form. They may have last year's software ready, so they file. Then another form arrives. A 1099 INT from a bank, a corrected brokerage statement, a 1099-R from an old retirement account, a dividend form they forgot was coming, a stock sale form from a brokerage account, or a home sale statement that changes the picture. And now the return does not match the paper trail. The first form retirees should watch is the 1099-R. That is the form used for distributions from pensions, annuities, retirement plans, IRAs, and similar accounts. If you took money from a traditional IRA, an old 401k, a pension, or certain annuity contracts, this form may matter. The second form is the SSA 1099. That is the Social Security benefit statement. It reports the net Social Security benefits you received, and that amount is used on your federal tax return. The third form is the 1099 INT. This one matters more now because many retirees moved money into CDs, high-yield savings, or bank products that finally paid real interest. That interest may feel small compared to a pension or IRA withdrawal, but it can still add to the return. Then there are investment forms. A 1099 DIV can report dividends and distributions. A 1099-B can report sales of stocks, funds, bonds, or other securities. And brokerage tax packages can be corrected after the first version arrives. That is why the danger is not always hiding income. Sometimes the danger is filing before every form has arrived. So before you file, build a simple paper trail checklist. Social Security statement, every 1099-R, every bank interest form, every brokerage tax package, every dividend or stock sale form, any corrected form, any HSA form if you used one, any home sale statement if you sold property, and any Medicare premium notice that helps explain income-related costs. Then ask one question. Is this everything the IRS may also receive? Because the IRS mismatch letter does not care that you filed early. It only sees that what you reported and what it received do not line up. And after the forms are gathered, the next step is not guessing. It is checking the return in the right order. After the forms are gathered, the next mistake is checking them in the wrong order. Many retirees start with one question. Do I owe money or do I get a refund? But that is the last question. The first question is, what changed before the refund number appeared? So before you file your 2026 return, check the return in this order. First, confirm your filing status. Married filing jointly. Single, head of household. Qualifying surviving spouse if you are eligible. Married filing separately. Do not treat filing status like a label. It changes the standard deduction. It changes Social Security tax thresholds. It can change whether certain deductions phase out, and it can change how painful the return feels. Second, check the 2026 standard deduction. Do not just copy last year. The IRS increased the 2026 standard deduction to $32,200 for married couples filing jointly, $16,100 for single filers and married filing separately, and $24,150 for heads of household. Third, if you are 65 or older by the end of the tax year, check both senior-related deductions separately. There is the existing age-based additional standard deduction, and there is the newer enhanced senior deduction. The IRS says the enhanced senior deduction can be up to $6,000 per eligible person, or $12,000 for a married couple if both spouses qualify. But it phases out above $75,000 of modified adjusted gross income for individuals, or $150,000 for joint filers. So do not only ask, did I get it? Ask, did my income reduce it? Fourth, add every income source before you judge your Social Security taxes. The IRS test can include 1/2 of your Social Security benefits plus other income, including tax-exempt interest. If that combined number goes above $25,000 for single filers, heads of household, or qualifying surviving spouses, or $32,000 for married couples filing jointly, part of Social Security may become taxable. Fifth, check every retirement account for RMDs, every IRA, every old 401k, every inherited account, every account you forgot was still open. Do not assume one statement covers the whole picture. Some IRA RMDs can be calculated separately and taken from one IRA. but 401k and other plan RMDs usually need separate handling. Sixth, check whether one income move could affect Medicare later. A Roth conversion, a large IRA withdrawal, a capital gain, extra interest income, a home sale with taxable gain. For Medicare, modified adjusted gross income generally means adjusted gross income plus tax-exempt interest. And Medicare premiums can use income from 2 years earlier. So ask, will this income matter 2 years from now? Seventh, check withholding and estimated payments. If your IRA withdrawals, pension income for interest, or capital gains changed, last year's withholding may no longer match this year's tax bill. A refund or a balance due is not magic. It is often the result of what was withheld, or not withheld, during the year. And finally, before you click File, ask one last question. Is every form here? Not just the forms you remembered, the forms the IRS may also receive. Because a clean retirement return is not built by guessing. It is built by checking the pieces in the right order. So here is the action plan. Do not panic. Do not assume the IRS changed everything in your retirement overnight, but also do not file your 2026 return on autopilot. Before you file, put every tax form in one folder. Your Social Security statement, every 1099-R, every bank interest form, every brokerage form, every corrected form, every paper connected to a withdrawal, sale, pension, or Medicare premium. Then compare this year to last year, not just the refund, the filing status, the standard deduction, the senior deduction, the IRA withdrawals, the RMDs, the Social Security tax calculation, the Medicare income lookback, and the withholding. Because the most expensive surprises usually do not come from one obvious mistake. They come from small numbers that connect quietly, a little more interest, one extra IRA withdrawal, a Roth conversion, a corrected brokerage form, an old account that still required an RMD, a Medicare premium notice based on income from 2 years earlier. Each piece may look harmless alone, but together they can change the return. So before you click File, ask one final question. Did I check the whole retirement picture or only the form in front of me? That is the difference. Retirement did not change because you did something wrong. It changed because the numbers around your retirement moved. And the retirees who notice early are usually the ones who avoid the most painful surprises later. If this helped, the next video will show the retirement tax moves that look safe on paper, but can quietly make the IRS bill bigger.